festive season is going to do, and given that it's already kick-started, how are things likely to pick up? And who better than Rajesh Kumar, the MD and CEO at TransUnion Sybil, joining in on the show to throw some light on how the consumer pulse has been shaping up. Rajesh, hi, good morning. Great to have you in ET now. Early days yet, but given that festival season has already picked up, tell us what are the consumer trend patterns that you're witnessing right now in terms of how they're spending?
Good morning. Thank you very much for having me on the show. These are interesting times. We've come off a couple of years of high growth post the pandemic, and if you look at the overall credit growth, the retail portfolio balance is at a growth rate of 23% versus a 28 and 30, etc. in the past. And as we go into the festival season, of course, we've had some headwinds in terms of the relatively high credit to deposit ratio and some regulatory interventions on the personal loan side, particularly where things were heating up a little bit in terms of over leveraging by a small segment of customers. But coming back to the festival season, therefore, I think I would like to take the position that, our long-term story is very, very strong. If I look at our data over a 20-year period, Aisha, we've grown 2 to 3x every 5 years in terms of the retail portfolio size. Any 5-year period over 2 decades. And then likewise, if you see on an annual basis, depending on the cyclical nature of the year, the retail portfolios have grown 2 to 3x the GDP growth rate. So keeping these in mind, I wouldn't give too much weightage to the current headwinds. A little bit of moderation is always good in the lending world, and we have very timely and proactive action or interventions by the regulator which ensure that financial stability is maintained. So a little bit of a moderation, I think, is good and has come at the right time. Coming back to the festive season, very early days as of now. Last year we had a 7% growth in the last quarter. A lot of this is determined by when the big e-com sales happen, what is the timing, and also when Diwali, etc. is. So there is no fixed number on what to expect, but I think we'll have to wait and watch very initial days on actual number trends though.
Okay, point taken. But Rajesh, you're talking about the timely intervention coming in from the regulator there, but one needs to understand where is it coming from, the caution in the first place. Are there any early signs of, let's say, delinquencies being higher? Are there any signs that this rise in consumerism is leading to inflated borrowings?
That's a very important question for us to understand. So if you really look at what's been happening in the new origination of loans, right? So before the regulatory interventions, we saw very high and also the CD ratios going over the top. We had a very high growth rate in loans below 50,000 in particular. And there was a segment of customers where the number of loans they took in a short period was rapidly climbing. So, and not just that, I think the credit deposit ratio hitting a 79-80 was anyway unsustainable. So I think the interventions came at the right time. Coming back to your question on the consumerism, I have a view that in a country with such a large young population, aspiring middle class, rising incomes these days, and most importantly, lifestyles heavily influenced by social media, right? This consumerism is a given by now. I think that's what we see world over. So that's the demand from the market. As suppliers of credit, the lending institutions, it is for us to understand which are the segments that tend to get over leveraged. It's not just any age group. For example, if you see credit card utilizations, etc., it's not just millennials or Gen Z, right? It's across age groups. Likewise, it's not just metros or rural markets, it's across. So these are by now, I think, universal trends in terms of socio-cultural behavior, if I may say so. So I think it's really up to the lenders now to identify the profitable segments, identify the risky segments proactively, and accordingly channelize their growth. But again, having said that, if you look at the last 5 years, we've had more than 2x growth in terms of the sheer number of young borrowers below the age of 30. Gen Z is almost 4x on growth. Women borrowers is more than 2x, and that reflects across semi-urban and rural regions, which means this trend is here to stay. It's just up to the lenders to manage this well enough.
Okay, fair enough. And wanted to just also understand, I know you did talk a little bit more about the credit card profile, etc. But what about in terms of spending and credit card issuances? Can you throw more light on those details?
Yeah, so credit card, definitely there has been moderation all round. So first things first, in terms of new origination, there is a drop of almost 30% versus the previous year, same period, A. And B, in terms of the spends, right? The credit utilization, if you see, right? The actual utilization versus the limit given. So typically we like to look at what percentage of customers have crossed 90% of the limit in terms of utilization within a period of 6 months, right? That's like pretty quickly you use up all the limit. And this number has indeed grown 3 to 4x over the last 5 to 6 quarters. So, for example, if I were to cut it age group wise, if I were to cut it metro versus small city wise, if I were to cut it ticket size wise or the credit limit wise, everywhere the trend is very similar. So, if I were to give you an example, let's say in a particular age group, say 35 to 45, if 3% of customers used to end up using 90% of the limit in 6 months. Today, that number is at a 12%. So there is a 2 to 3x or 4x growth across every group in terms of the number of customers who actually end up using 90%. So clearly there is an increase in the utilization percentages. And then coming to delinquency, of course, first thing is utilization. Then how much of what you utilized as a limit do you pay on time is what leads to delinquencies. So credit cards has seen the latest numbers point to about 20 bips increase in delinquency in credit cards. And that's again fairly evenly spread across age groups. I wouldn't single out millennials or any particular geography, etc. It's fairly evenly spread, this increase in delinquency. But I would also like to point out a couple of possible factors. One is that the overall issuance has reduced, which means the rate of the growth of the book size or the denominator, as we say, is obviously slower versus what it used to be. In such a scenario, usually the delinquencies go up, A. And then B, also, I have a view that when you talk about credit cards, we all use UPI so much more, right? So a lot of good spends have gone on to UPI, which otherwise would be in the month end or the reporting cycle book size. So to that extent, over the long time, I would anyway expect some increase in delinquencies in credit cards.
In the very near term, though, Rajesh, do you think the festival season can sort of give a leg up and fillip to spending?
It usually is, Aisha, in the sense that typically all these sales happen, all these discounts happen. So usually festival sales and over the last 25 years in this field, I've always seen there's also a lot of auspicious purchases. We like to buy things on auspicious days. So definitely I am expecting a good growth this festival season, notwithstanding the current slowdown in the last 2-3 months. Again, relative to the previous quarter, there should be a good enough growth I'm looking forward to.
Thanks, Rajesh, for making time and speaking with us. So optimism is there that perhaps there is going to be a pickup, but let's see which way it really goes. In the meantime, just...
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.